What's happening, investors? AK here, bringing you the noise where we analyze the market and business news that you need to know. Let's go! So your number one question is probably whether this market drop is for real, right? Well, looking at the S&P futures this morning, it looks like we won't be getting a Black Monday, so you can relax a bit. Now, of course, things can change during the day, but let's quickly analyze what's going on in the market and what you should be doing about it. First thing to note is that the S&P is resting near its technically important 200-day moving average. And this moving average is lining up with the index's 2-year trend line as well. So this should be a fairly strong support. And based on the current action I'm seeing, it looks like this level is holding for now. As far as the fundamentals go, I covered it in last week's video about Gunlock's call for a market top and how our team disagreed. If you didn't see that video, I'll link to it above. Long story short, I'm still bullish. And here's some more bullish evidence for you. This chart shows earnings revisions for companies in the S&P compared to S&P price action. As you can see, earnings revisions lead the market. When earnings are revised higher, the S&P follows. And right now, earnings are being revised higher, so we should expect the S&P to follow. The next thing we have to look at is sentiment. CNBC's Fear and Greed Index is currently showing extreme fear. Now, sentiment is a contra-indicator. So when there's extreme fear in the markets, we can expect a near-term bottom. And when there's extreme greed, we can expect a near-term top. It all goes along with Buffett's saying of being fearful when others are greedy and greedy when others are fearful. The fear we're seeing right now is a sign of the bottom. Another sentiment gauge, Bank of America's Bull and Bear indicator, has also come down from the extreme bullishness that can be looked at as a sell signal. So in summary, is this the beginning of a bear market? I don't think so. Especially when all the bears are trying to call a top here, it makes me even more skeptical. There's been a lot of different factors attributed to this down move, like Trump's trade wars, the regulations on big tech, and rising interest rates. These things may have contributed, but we may also just be returning to normal market volatility. A lot of investors have forgotten that markets don't go just straight up. And I know that's easy to forget when we just had one of the least volatile, easiest years ever in 2017. But markets are like a pendulum that swings back and forth. If we have super easy, non-volatile markets for a period of time, then you need to expect tough, highly volatile markets to follow. And that's probably what we're seeing now, so don't get too shocked by every move. Now, I think the markets hold at this technical level and move higher from here, but it wouldn't be a huge surprise if the S&P 500 spikes below the 200-day moving average to form a bear trap before it decides to move higher again. So how should you be playing this market action? Well, you know what I'm gonna say, right? Just stick to your investment plan. The best thing we could do as investors right now is just to patiently watch the price action. We have to let the market signal what it's gonna do. No one knows what's gonna happen. Not me and not anyone else. So if you have a lot of positions on, watch them closely and cut them when they hit your risk point. Stick to your plan. These stocks might hit your risk point, force you to exit, and then rebound the very next day. But don't get frustrated. You should be happy that you're controlling your risk, because things could have easily gone the other way. And if you're getting stressed about these day-to-day volatile moves, then extend your time frame. You need to zoom out. Stop looking at the daily chart. Check out the weekly chart and the monthly chart. The best returns are made over the long term. Remember that you're playing this game over the long haul, so don't stress out too much about these daily moves. March Madness is for basketball, not for markets. So get away from your computer and go focus on Michigan winning this tourney. But before you go, make sure you subscribe to this channel and hit that bell for notifications of new videos. I'll talk to you tomorrow.